We'll go ahead and get started. I know we had a bit of a late start here, but thank you everyone for joining us as we wait for everybody else to come through. I'll go ahead and give my introduction. I'm Shane Pinnock. I run the events over at 10 Capital Network, and today we have a great session for you on how crowdfunding really works with Ben Kromnick of Fundify. So with that, I'll go ahead and pass it over to Hall, but if you have any questions during the session, feel free to drop them in the chat and we'll get to them at some point. All right, Hall.
Great. Thanks, Shane. And I want to thank everybody for joining us today. And in particular, I want to thank our special speaker, Ben Kromnick of Fundify. I've known Fundify for some time and found it as a really great resource for startups to find funding, and invited Ben to come on and talk today about their experience with how crowdfunding really works. I find when I look out at the marketplace, there's a lot of misconceptions about what crowdfunding is and what's going to happen, and in particular, who does what. And so invited Ben to really give us more of the down and raw view of crowdfunding and what to expect from it. And then we'll have you post questions over there and get into them after he gets through with his initial introduction. With that, Ben, thank you for joining us, and go ahead and take it away and tell us more about your background as well as how crowdfunding really works.
Sure. Thank you so much, Hall and Shane. It's been a pleasure working with both you guys and meeting your community, and really excited to join the conversation today. So a little bit about me. I am Ben Kromnick. I'm the VP of Startups at Fundify. It's kind of a funny title, VP of Startups. We're a platform business, which means that we serve really three fundamental customers. We serve our startups, we serve our investors, and we serve our regulatory overlords. We care about all three in very different and important ways. So I am responsible for really all of our engagements with our startups, from support out in the community, education, and nurturing, all the way through the regulatory side of things with each startup, making sure that everything is above board and ready to be filed and maintains compliance over time, both during the campaign and after the campaign. And then also getting our campaigns launched, facilitating them with best and better practices on how to build their campaign successfully, launch their campaign successfully, and inevitably close them successfully. That's all pretty hard. And equity crowdfunding sounds really nice, kind of the same way like raising a round in venture capital sounds really nice. You go out, you talk to VCs, you get your checks. Crowdfunding, you issue your CF and investors come. Well, it's never, as any of us who have ever raised capital for our own businesses or with other businesses know, it's never quite that rosy. And what we wanted to do in this conversation today was talk about kind of the down and dirty details of equity crowdfunding. What are the challenges that companies have? How do you optimize around them? How do you mitigate them to make sure you can be successful? And really assess if equity crowdfunding is the right path for you. And if it is the right path for you, there's a lot of different ways you can squiggle through that forest and help you kind of look through the trees and make the right turns as you're navigating equity crowdfunding, because there's a lot of different ways that it can fit. So what I'm going to talk about, a little bit about my background, the reason why I'm here is I know how hard it is to raise capital. I've raised capital for my own businesses as a founder and as an entrepreneur with multiple startups over the last 8-10 years. And I helped to found Fundify with our two other founders, Josh Chodnowitz and Craig Fryer, because we've all felt that pain. We are all technologists and investors and product-led business owners. We thought we could do it better. We thought that the industry could be better. And you're seeing just incredible strides have been made since we really started tracking the market in 2016, got into the market in 2018, 2019, really launched our platform in 2020. So we're making huge strides in solving some of the major problems of equity crowdfunding. We'll talk about what some of those are. And I want you all to know that the reason we're here, we're trying to solve those problems, we felt them ourselves. Which is one of the biggest gaps. One of the things in the equity crowdfunding market is I would look for in finding your equity crowdfunding partner, whether it's your intermediary, your portal, or it's your advertising team, or it's your legal team. Making sure that they really have been there, have been in your shoes before is an important factor. So I'm going to kind of go from beginning to end in an abbreviated fashion of some of the major kind of challenges and sticking points in equity crowdfunding, and then we'll get into some of the specific questions from there. So I'll take just a couple of minutes to get through the process. But the first thing to look at for equity crowdfunding, how it really works, quote unquote, is, is it really the right fit for you? It's not good for everybody. And it's really not about your industry. It's not about your stage. It's about the context of the business. And I'll give you a great example. There was an equity crowdfunding campaign that was out there for a while, and it's a biotech company. Biotech is not a traditional crowdfunding approach. So, but the context of the business made it that crowdfunding is actually a great fit because it had to do with COVID. Launched their campaign during COVID, and it's actually a therapy to help solve the actual deadly components of COVID, to result in essentially pulmonary issues, and solves essentially the leaking of fluid into your lungs. It's a huge, gigantic problem. And it's got a machine learning component to it. There's a data discovery component to it. It's a really attractive business. And because it had this COVID component, they thought, well, we think we can fundraise through the crowd to get us through some of the hardest parts of biotech, which is that preclinical financing is really hard in biotech. So they went the crowdfunding route. So actually the context of business fit. What didn't fit was the sentiment and resources of the business to do crowdfunding. Because just because you've got a great story to tell doesn't mean it automatically gets told. And the founder struggled to actually tell the story broad enough, with enough consistency and enough precision and impact to motivate enough investment to make the campaign successful. So while the industry wasn't traditionally a good fit, the context made it a great fit, but the resource structure of the business made it a challenge. So the first thing you're going to want to look at when you're assessing to go down crowdfunding is not is there a great analogy for my business in crowdfunding that's knocked it out of the park? It's what about yourself as a founding team, as a business? Are you structured to do it? Do you have enough capital in the bank to fund yourself while you're doing the initial parts of the fundraise? Do you have the want on the team to get out there and really work your network? And it's working your network in a different way than you would for a traditional fundraise. You're not going to your rich friends and family. You actually are going to your entire network and working with your entire community and possibly engaging your customers or your stakeholders. And that's not for everybody. So that's really the first question to ask yourself is, are you prepared to share from your network, from your personal position to get the capital raised, at least to some component? And if you're not, you're going to want to consider a different path than equity crowdfunding. There's some other ways to mitigate some of that reticence. We can talk about that later, but that's the first thing that we're going to look at is, as a company, are you prepared to do that personal networking, that personal marketing to share the campaign? The second thing to look at here is, are you structured correctly? A lot of the times companies come to Fundify saying, how should I structure my business to do equity crowdfunding? And my first response is, I'm not a corporate attorney. And that's the next thing you're going to want to do. Like, if you feel like you've got the motivation to do it, the next step is your corporate structure in place to do this correctly? And you're going to want to have an honest conversation with your corporate counsel or with an informed advisor that can give you good advice about how to structure your business for this fundraise. Sometimes that might mean using a special purpose vehicle, which is a separate entity that aggregates all these investors onto one line of your cap table. Sometimes that means having a holding company and an operating company and an SPV. These are challenges that always stumble companies that come to us in the early days. And I recommend doing some introspection. How do you want to structure your business long-term before you go raise this capital? And that's a question that you're going to get asked. And you're going to have certainty on whether you're doing crowdfunding or a traditional fundraise. With a traditional fundraise, you can usually kind of push through it on an investor by investor basis. But with crowdfunding, it's a one-size-fits-all transaction. So you want to be really certain in your corporate structure and understand if your corporate structure supports it at all. Because you don't want one of the things that happens all the time with, especially when the special purpose vehicle became available in 2021 for equity crowdfunding, companies got really far down the line with building their campaign, had to stop everything, restructure their corporate entities, and then start again and update all their compliance documents and update their pitch decks to make sure these things were accurately communicated. So that's the next step. And the reason I share these things is this is the prerequisite work that gets you prepared. This is all the hard work that's all internal. There's no portal is going to tell you necessarily there's a right way or a wrong way. But you want to be really prepared, really have a solid foundation, because with individual investors on a traditional raise, some are willing to be lenient with you, some are willing to forgive a initial structure, they're willing to be along for the ride with you. With equity crowdfunding, you don't have that chance to have that one-on-one communication with every investor. And because of that, you want to be really tight in your value proposition, and be really tight in your corporate structure. And what you don't want is for an investor to not understand what they're seeing, and then down the road come back with an investor complaint to yourself, to the portal, or to the SEC. So having that really strong foundation, building your fundraising strategy before you even engage your equity crowdfunding portal, your intermediary, like a Fundify or WeFunder or Start Engine or Republic, that's gonna be really important. Those are the fundamentals. The next step that people don't talk a lot about is, or as people talk about the most rather, is your pitch. Pitch's got to be great. No way around it. That's not a dirty secret. That's not even like a how it works thing. Your pitch has to be really solid. What it doesn't need to be is a private equity pitch. This is actually not about really evangelizing necessarily the financial benefits of your business. That could be a huge part of it, but it's gonna be about motivating investors to convert. So you'll notice there's a trend with a lot of portals moving towards smaller and smaller, more and more concise, more and more visual pitch pages, because so much of the conversion that happens for these startups doesn't happen on page 18 of your financial model. It happens because they believe in you. They believe in your mission, and they generally believe that your valuation's in the right universe, and that you're the right team to do it, and that you've got an inspiring solution to the problem. So the actual conversion impacts, the conversion methodologies are really different in crowdfunding than they are in a traditional fundraise. I was just talking to a company that I'm advising about the four audiences for a pitch, and only one of those audiences is the shareholder and investor. There is also your staff and your stakeholders, your community. There is also the end customer, the end user of your product, and there's also your partner ecosystem that lives there. They're all care about your pitch. And for an equity crowdfunding pitch, it's not just the investor that you're talking to. You're talking to all four of those audiences. And depending on your business, you're gonna want to put different weight on those different audiences. And so before you do and go ahead and run your campaign, it's one of the places where a lot of marketing agencies fall down in this space is they go out with a standard boilerplate, this is the audience we talk to. And that almost is never gonna work, because it's about your audience. It's really specific to you. And the campaigns that you see be successful know how to talk to their audience the same way you're growing your product, right? You're not pitching your product to generically, women 18 to 35. No marketer is doing that on this call. You're pitching it to exactly who your user is, who they identify with, who they want to be. The equity crowdfunding campaign is going to be exactly the same way. That is work that doesn't get done enough by so many campaigns, and they always wish they would have, because they'll spend $5,000 to $10,000 in marketing when they get out of the gate and not get the conversion they're hoping for. Then that pain forces them to reconsider their audiences, forces them to reconsider distribution channels, forces them to reconsider their content strategy. So I highly recommend, forcing those conversations before you launch. Hall, it looks like you want to jump in with a question. Are you good?
No, keep going. Yeah.
All right. So that kind of leads me to the next part here, and this is something that I'm always shocked isn't used enough in equity crowdfunding, and every portal kind of feels differently about it. But the test the waters component of the CF exemption is something that at Fundify we are huge advocates of, but primarily because of all that uncertainty I just talked about. Equity crowdfunding is hard. It's really context based. It doesn't work for every company. So you should test it and use every methodology you can to test it. You know, before you even get into a portal, you can ask your community if they would be interested in investing in you. You can ask for things like donations. You can use, a lot of companies migrate from the Kickstarter and Indiegogo world into equity crowdfunding when they need to raise more capital. The test the waters exemption is a really great way to do that. And what that is, for any of you who don't know what that is a general solicitation, non-committal equity crowdfunding campaign. So what that means is you can build a campaign on a portal, you can advertise it in a much more broad, much less restrictive manner than you would for your live security, and see what kind of traction you get. We've had campaigns come out of the gate with hundreds of thousands of dollars in traction from their equity, from their Test the Waters campaign. Some of them are in the millions, and that now gives you the confidence in spending the time, effort, and resources to go spend the money to build the right campaign. And also helps you test your audiences. You know, you might think that the traditional conservative investor is going to love what you have, but you know, one of my favorite investments we've done with Fundify is a company called Marietta Gold. They're an actual gold mine. It's a really fun thing to market in equity crowdfunding. They've had traction with two types of people. They've had traction with retail investors who love the idea of buying into a gold mine, because how cool is that? They've also had traction with people from their network. They are in the mining community, obviously, who are interested and who know who they are, know their personal brands and their expertise, and want to invest to the tune of tens of thousands or hundreds of thousands of dollars. So you have the ability to sense those audiences, test those audiences out, and validate that you're going to have the success that you're hoping for. A lot of companies have different benchmarks they use for Test the Waters to even evaluate if you're ready to go live or not. We have one, for us, it's only $10,000, but we recommend it's actually, you do it as a multiple of your minimum. So if you're looking to raise 25,000, typically recommend you want to have 50,000 committed in your Test the Waters campaign. That way you have higher certainty of at least hitting your minimum. Every portal has a different threshold they use, and they change pretty frequently as the market evolves. So that's another component that's not used broadly enough, not used intentionally enough, that I highly recommend the community adopts more. And if you're here thinking about equity crowdfunding, it's a really low cost way to get started. I mean, with some portals require upfront costs in some ways. Fundify doesn't require that. We want people to test, and we want the people to have the success. And if they're going to be successful, then you feel good about making that upfront cost, as opposed to paying 10 grand and then not having the traction. And that costs you more than it probably should have. That's kind of everything before the launch. Now, the next thing I'm gonna get into is this kind of regulatory phase. Like I said, we have three customers. We have our startups, we have our investors, and we have our compliance and regulators. In the regulatory stage here, this is where we find all the bodies get buried, or rather they get unburied at this stage, if you don't do all that work ahead of time. And if you aren't really prepared, you don't have your corporate structure clean, you don't have your investment agreements in place, this is where you can have really long delays, and where you can get yourself into trouble where you really wanted to be out 2 or 3 months ago, but turns out you need to restructure your corporation, or you need to rewrite your investment terms, or you need to build an SPV. Those things can take time, and they can cause delays that you don't really want. You really don't want them when you're ready to launch. So in this regulatory stage, like, this is where you want to make sure that your portal, your intermediary like a Fundify, supports you in a really good way, or you're very clear about the resources that you need in-house. Every portal is going to service the market a little bit differently here. And when you get started with your portal, you want to ask, who's going to write the Form C? Who's going to approve and issue the investment documents? And who's going to make sure that we have the right corporate structure in place and actually do the filing for the CF exemption? Because oftentimes there's misconceptions about what's being done by whom. And that's where you end up having to pay a corporate attorney more than you'd like to at the last minute, because you're so close to getting out, but you thought the portal was going to do something for you that they actually don't do, or maybe they're not even allowed to do. So that really clear alignment up front about what the regulatory requirements are, making sure you're over those hurdles ahead of time, makes the regulatory process go really smooth and really clean. Other times you end up with lots of potholes and lots of rework, and it's the most frustrating thing because you've got people in your test waters campaign who are ready to invest. They want to help you. They want to give you their money, and you're stuck behind these compliance issues that are always foreseeable. The thing that's nice about equity crowdfunding is there is a standard. There is a way of doing. There's a way that the SEC needs things to be done. Every one of your portals is going to know what that is, and it can always be foreseen. The requirements are clear. You just have to do them, and you got to do them correctly. And I'd make sure to validate that before you take too many steps down the road with marketing expense, especially. I'm going to pause there. That's kind of all of the, or not all of it. It's some of the highlights of building your campaign before it actually goes live. I want to make sure that also saves lots of time for actually running the campaign successfully. How do you capitalize it during the campaign and then closing and further reporting? But I want to pause there for questions.
Sure. So I had some questions to put out there. If anybody in the audience wants to join in, please post them in the chat box. Can you run the CF campaign while raising from angels and VCs at the same time, perhaps doing a Reg D? How does that work?
You absolutely can. It's called a Reg D side by side. There is an implication though. The implication is you have to raise on the exact same terms. This is this entire spirit of crowdfunding, is that the same terms, the same investment is available to all investors during that campaign. So what you can't do is go to an angel and give them a bunch of preference while you're selling really expensive securities to your crowd and to your community.
And so my next question is, what % of the fundraise you think comes from the portal versus the network of the issuer? What's the expectation you would set to the audience here today?
The expectation I would set is that 100% of the investment comes from the issuer. Now, that should be your expectation, because you don't want, this is what kills more campaigns than anything, is the expectation that somebody else is going to bring money. It's always hopeful, and it's something that it typically ends up in disappointment, or at least it's less than you hoped it would be. So now that said, every portal operates very differently. Start Engine, for example, provides a big list, and they provide a lot of resources behind it, and they will take fees on the money that they convert. Other portals don't do anything. Others kind of live in between. So it really depends on the portal you're working with and what their commitment to you is and what the capital structure is on that, for what your expectations would be. With Start Engine, I would expect much higher things than with WeFunder or Fundify or Republic in most cases.
Great. The next question is, what access to data does the issuer get during the campaign? I find a lot of startups are really surprised that they don't get the full list. They get redacted information. What should they expect there?
Yeah, again, that's a portal by portal issue based on the privacy agreement that the portal has with the investor. Now, for Fundify, the privacy agreement we have with our investor is that if you've made a commitment on Test the Waters, or you've made an investment, that your first name, last name, email, investment amount are made available to the startup because you're on their cap table. You are an investor. And we think that is a reasonable exchange and is the right amount of information to share. We also do things like on a weekly basis, we do a Google Analytics review with our startups, so they know what traffic is coming. We make sure that they're using the right trackers, so that we can actually track their sources of traffic, because they should be able to independently verify attribution. Because one of the things that's hard is that every marketing agency does attribution a little bit differently. And we want the startup to be as equipped as we are to understand the sources of traffic to their page, to be able to manage their spend adequately.
My next question is, most platforms require you to have the first 250 raised from your network before they actually engage or provide any other support. Aside from your network, what are the best ways of reaching that 250K goal?
Yeah. So every portal, again, is going to manage that. When do we get engaged and how question a little bit differently. And oftentimes they use a threshold as a great way to say no as the rule. And then as an exception, they'll elevate certain companies for different reasons. Now, to get to that first 250 is the hardest part. It is the hardest thing you're going to do in equity crowdfunding. The way to do it, so of course, your network is crucial. If you can't raise some of that, some fraction of that from the people that already know you, you're probably going to have a hard time. That's exactly why we recommend the Test the Waters campaign, because that's exactly who you're going to want to share your Test the Waters campaign with, the people who already know you. So if you're not getting traction in Test the Waters from your first degree connections on LinkedIn, your followers on Twitter, your followers on Instagram, then equity crowdfunding is probably going to be a real uphill battle for you. And your cost of capital is going to end up being higher than you would hope, and you probably won't take a different path. Now, if you are able to have some success with those initially the first people that know you, the second place is that companies often go to is their product itself. So if you are a marketplace product, in your marketplace, using a banner ad that says, do you want to invest in this marketplace? And allow them to source traffic from your users into your campaign is a really effective manner. Another one is at checkout. So if you are actually doing a purchase flow, having it at the purchase flow where you have that user's attention, or part of your overall brand advertising. I think there was just a great question in the chat here from Robert Samuelson about why use a portal at all. I mean, you could do it on your own.
Go ahead and read it out and answer the question.
Yeah, sure. So the question is, why use a portal instead of a private label Reg CF broker dealer, especially when entrepreneurs bring in some investors? It's funny. So the leader in that space is a company called Dealmaker, who I am a huge fan of. Love what Dealmaker is doing. I love their approach. And here's one of the big differences you often see. If you use Dealmaker or something similar, you are responsible for all of that marketing. You're also very much responsible for a lot of your compliance work. Your costs can be higher if you want to have them do the work for you. So they look more like a broker dealer, where it can cost you $10,000 to $20,000 to get it set up. That said, I'm a huge fan of Dealmaker, especially when you're leveraging your own brand. Where a portal can be really useful is if you do need that baseline level of brand recognition, it can be very useful. If there are similar companies to yours that are driving traffic to that marketplace, you can get high crossover. Fundify actually has an industry-leading crossover investment rate, because the investors that come to us invest in multiple campaigns. And for example, if you're investing in 5G, you might also be invested in an EV investment company, or an EV infrastructure company. So there's a number of values to using the portal, but there are absolutely great reasons to use a CF broker. And again, this is about the context of your business. So do you want to manage that API integration that actually does the transaction facilitation on your own website, or do you want to be hands-off and let that be run on a separate page? Really up to you. There's also a lot of web development work that can come into play with that, where you're going to have to design your whole pitch page as opposed to fitting it into a portal. You also don't necessarily borrow the credibility of the portal. Portals carry with them the sense of certainty, credibility, and reliability that some investors really like. But if you as an entrepreneur can carry that, and you can carry the initial upfront cost of setup with a CF broker dealer like a Dealmaker, then it's a great option. And if anybody wants to talk to them specifically, happy to make a referral to them.
Great. Our next question is, do you get a competitive advantage if you have your website domain URL that is highly descriptive, such as crowdfundingathletes.com? Is it worth putting one of those together, or do you find that doesn't work?
That's a really good question. I'd have to see the SEO data to tell you. I go back more to context. If you're trying to if the purpose of your website is to drive crowdfunding investors who are interested in investing in athletics, that probably is useful from SEO purposes. But there's other ways to create a similar SEO impact by blogging or tagging or keywording on a page that has a more logical URL that actually describes your business. You can use subdomains that can be really useful. So it can be I'm shooting dark here, but athletes.com/crowdfunding. would have a similar SEO impact than actually taking over your whole domain.
Great. If you have any more questions in the audience, please post them. My next question is how long do most campaigns run, and how long should you let it run if you're not going to reach your goal? Should you shut it early at some level? How do you make that decision?
That's a great question. So sadly, like all of my other answers, it's all context related. So if you're raising around slowly over the next 12 months, let's say, and you expect it to be slow, doing a 12-month campaign is more than fine. You expect to launch it, you get some of your friends and family in, you get 10, 50, $100,000 in the bank. You do a rolling close, you close on some of that capital, go run some business, you just spend a little bit of money on some more advertising, you get a little bit more in. You can do that over the course of 12 months, and it's going to be a slow drip. It's hard to raise 5 million that way, but it's a reasonable approach to raise $250,000, $500,000 over the course of 12 months if you don't urgently need the capital. That's one approach, and companies can do it successful. The hard part with that is consistency. You have to stick with that. You don't want to just forget that it's there and let it lay fallow for too long. That'll end up making it harder and harder to reactivate and to re-engage your communities. So you're gonna want to keep like some kind of a drip going in your advertising or in your messaging if you're gonna do a long campaign like that. And that's really about your expectations and your willingness to keep it open for 12 months and know that there might be liquidity. Maybe it's once a quarter at tens of thousands, or maybe if you're lucky, hundreds of thousands. The other version of this, and you're seeing this really popular in Europe, growing in the US as well, is the 30-day campaign. But it's a bit of a misnomer in that the campaign is open for 30 days. By law, it has to be open for 21 days before it can be closed. So it might be open for 21 days or 30 days, but you're working for 6 months at a time to build up all of the potential energy on day one. Rad AI did that really successfully earlier this year. I think they raised $5 million in, I think, 9 minutes, something insane. But it wasn't 9 minutes. It was 9 months that all got capitalized, all came to fruition in 9 minutes, which is an incredible feat. And they should be applauded for the organization and collaboration that they did to actually close on that quickly, capitalize on all of that momentum. But it didn't happen in 9 minutes. It happened in 9 months, and it all came to fruition then. So duration of the campaign is it's only one component, and it's a tactic. It's not like actually a constraint. Your constraint is how long are you willing to work on this thing? How much effort are you willing to put into it? And then the duration the campaign is open is more a closing tactic. Do you want to close on it in 30 days or in 365 days? And that should be part of your overall strategy. Now, to address the second component of your question is, what if it doesn't work? How long do you leave it open? It depends on you. It depends on your business. There are some businesses where leaving a no traction campaign open and on the public internet could hurt your business. That's really contextual. It really depends on your market and your industry and your business. If you're hearing negative feedback on it and you're not raising capital on it, you should probably take it down, especially if it's not raising the capital you want. If you just don't have the time to focus on it for 2 weeks and traction slows and momentum slows, and you know you're going to get back to it in the next 2 weeks, you're going to get it to pick back up again. That's okay. You can kind of let that period of time lapse. I don't recommend it. I recommend full engagement for the full period of time. That you're going to get more for your money the shorter the campaign is. But after a certain point, you need to listen to the market and listen to the traction. And if it's not working, be honest about that yourself. It's the same thing as after a VC tells you no, going back to them again and begging them for a yes almost never works. Crowdfunding is kind of the same way. If the market isn't bearing what you hope it bears, and you've run your marketing experiments, you should test. It shouldn't just go out once and go, oh darn, it didn't work. Get it out there, test and experiment on different avenues, different messages. But once you've exhausted that effort, don't keep chasing that dog.
Cool. My last question is, you talked about using or trying to get customers to become investors. Have you seen much success with getting investors to become customers? And one example for putting it on your own website is you can put the Invest Now button and try to get investors to become a buyer as well as a investor.
Yeah. I've seen it more in B2B. I'm sure it happens, especially in in the product space, right? And you look at the Indiegos and Kickstarters, exactly that, right? I support you, and I'm going to essentially do a pre-order. The pre-order is really an investment, which means the investment kind of becomes a customer, and you hope they do a reorder. And we saw that with our very first campaign company called Baby Barista, where a lot of their investors were like just champing at the bit to become customers of their product. And they will eventually when the product goes live, hopefully next year. The thing you do see often is in B2B. So companies will get discovered through a crowdfunding campaign where it's like, man, I have this problem, or I'm looking for an acquisition in this space, and they get discovered through their crowdfunding campaign, or they get re-engaged in their crowdfunding campaign where this potential partner or potential customer might be in their market, it might be in their network already. And the crowdfunding campaign piques their interest enough to get them into the conversion funnel. So you do see that. I see it more in B2B in a meaningful way rather than in B2C. I think it's more of a reinforcement effect as opposed to a primary source of acquisition.
Great. Well, in the last few minutes that we have here, can you wrap up with more details about what you should do during the campaign and after the campaign?
Yeah. The first thing I want to talk about is something that doesn't get talked about enough, and most entrepreneurs don't know about this when they go into crowdfunding. To me, it is one of the most attractive components of equity crowdfunding is how you capitalize yourself during the campaign, because you have to only raise capital at your terms while you're doing an equity crowdfunding campaign. So you can't be going out to angels and saying, well, I need your money. I need 50 grand from you at preference to go put it into marketing and go run a crowdfunding campaign that I've got right now. You can't do that. So if you can't do that, how do you capitalize your business while you're running this campaign and you're spending money on this campaign in addition to running your business? So the SEC allows for what's called a rolling close. Rolling closes are when every time someone invests money in your crowdfunding campaign, that money, when the transaction is completed and cleared, lands in an escrow account. That escrow account keeps a ledger of everybody who's invested in and at what amounts. Once you've hit your minimum in the campaign, the SEC allows for you to actually withdraw from that account. Now there is administrative burden to that. You have to notify investors that you're doing a rolling close, but they don't have to do anything. They just have to be notified. And then whoever your portal is has to actually execute that transaction for you. Every portal is going to handle those things differently. At Fundify, we ask you to not be a jerk. We essentially say, we want you to be as capital flush as possible throughout the whole process. We want to enable you to have the capital in your bank operating, spending money on the campaign, advertising the campaign, and most importantly, growing your business, because your own business growth is going to be the biggest driver of the campaign. So that's something that a lot of entrepreneurs don't know that they can ask for. And for a portal, it's actually administrative cost. So a lot of portals don't necessarily talk about it or evangelize it as much as they possibly could. And that's one component. The second is monitoring cost of capital. So when you're raising capital, there's always a cost. You can go work with Hall, pay Hall's retainer, and Hall can go help you raise some money, which is a wonderful way to go about capitalizing your business. And there's cost to that. There's also cost to running an equity crowdfunding campaign. And the cost for an equity crowdfunding campaign is somewhat variable because you're paying your success fee, which is, at Fundify, that's 7.5%. At Dealmaker, if you're doing, broker only, that's about 4% plus some upfront cost. Every portal is gonna look different. But then there's also your investor acquisition cost. That's the variable you're gonna want to track really closely, because while you might be able to raise 5 million, if the last 2.5 million of that round costs you 60 cents on the dollar, that's a really inefficient way to raise that capital. And you didn't raise 2.5 million, you raised 40% of 2.5 million. So you had to spend 60% to get there. So while you're able to utilize that rolling close to capitalize maybe your marketing campaigns or your acquisition campaigns, you're also spending money to acquire each of those investors. So you want to track that cost of capital ratio really closely and set an expectation before you launch your campaign. So for example, you might say, with a traditional broker dealer, I'm paying 8% to raise my capital. But I think I could only raise $1 million that way. And I think it will take 9 months. And there's no marketing or branding value to that. Maybe there are in different ways depending on the broker dealers you use. In crowdfunding, you're paying your success fees. That might, let's call that 7% for a simple number. And then there's your acquisition costs. So if you're spending 10% in acquisition, now you're looking at a 17% cost of capital. But if you can raise more money and you can, and a lot of that has that's multi-use capital. You're also doing, that's also brand lift. It's also customer acquisition lift. That might be the right cost for you. Maybe it's 27, maybe it's 37%. But that's a piece of financial analysis I recommend to every single entrepreneur does this before they go raise any capital, is determine what their cost ratio is they're comfortable with. And then that'll be a really useful tool when you go to work with your marketing agency or if you're doing that internally to set that benchmark. You will only spend money up until that cost ceiling. After that point, you need to go optimize. You need to go find new channels, or you need to stop spending and just stay comfortable at a slower acquisition rate. And that kind of discipline is what makes these campaigns actually successful, unless they're pure brand. And there are $5 million campaigns that go out now at inflated valuations at really high spend because it's actually a branding exercise more than it is a fundraising exercise. You know, if you spend $3 million to raise $5 million, you net $2 million, but it has a huge brand lift for you and you already have a $400 million valuation, that could be a really great situation for you. But just know what your desired outcome is from the onset and set your financial metrics in place first. And that will help you working with marketing partners. It will help you working with your service providers the whole way through. That's the biggest mistake that entrepreneurs make in crowdfunding is they don't set that expectation ahead of time. And they get to just ready to launch and they go, man, I spent all this money on lawyers and on accountants and on copywriters and videographers. I haven't raised a single penny yet. So now I'm behind in my cost of capital. And then you go to the marketing agency, and marketing agency is going to want, tens of thousands of dollars in commitment. And you're looking at this bill, you haven't raised any capital into it yet. So if you can set that expectation from day one, what your desired cost of capital is at the end, that will help you work backwards into negotiating the right contracts with all your service providers and your marketing providers and your portal. Every portal is negotiable, by the way. They might not all tell you that, but they will all negotiate their success fees. Well, Fundify will. I won't speak for other portals, but ask.
Quite a quick question. What % of the campaigns are doing just that, branding exercises versus fundraising? I had a Kickstarter group that used Kickstarter where they would actually use it for market testing, never actually took the funding. They just wanted to see who clicked on what and test the different name and all that stuff. But on the equity crowdfunding portals, how many are using it for branding only?
Man, that's a hard question. I couldn't tell you. I think even if you asked the entrepreneurs, even the ones that look like they're doing for branding only, might not know that or might not say that, because it's a little bit blended where you start to convince yourself sometimes that a high cost of capital is worth it because of the brand lift. You might not have started out with that intention, but you might going to end at that intention because it feels really good, right? You're getting money getting money in the bank, you're getting traction, and you're spending into that. But you might feel comfortable with that because the brand lift is good and other parts of the business are succeeding as well because of it. So it's a hard question to answer.
Well, great. Well, if there are any questions in the audience, please go ahead and post them here. Ben, can you post your contact details so people can get back in touch with you on the chat box? And looking forward to, go ahead and give us some closing words of wisdom here for those who want to do crowdfunding. What can you guys do for them at Fundify?
Yeah, words of wisdom are test and iterate. Really validate that equity crowdfunding is the right funding solution for you. Validate your messaging, validate your market and audience before going all in on it. You're gonna be much more successful that way. Go ahead, Hall.
And how is Fundify different from all the other platforms?
We will have that conversation with you on day one. That's what makes us different than other portals. We are much more boutique in that sense. We work much more closely with our founders before you've raised your $250,000 into your campaign. Fundify is also putting out a new product later this year that will help to capitalize businesses much sooner in their crowdfunding journey, based on more of a venture diligence process as well. So what's another huge differentiator there? I'll happily share more details when the product is in market.
Great. Well, I want to thank you for joining us today, Ben, and appreciate all the wisdom you shared. And I think we really do, hopefully people understand better how crowdfunding works with eyes wide open. And those in the audience, thank you for the good questions and thank you for joining us today. We'll be glad to share more details with you in our next session as well, but appreciate you coming out at this point. And with that, we'll go ahead and wrap it up. Ben, thanks so much and appreciate all that you do for us.
Yeah, of course, everybody shoot me an email if you have any questions, reach out to me on LinkedIn. Oh, I put those into the panelists. So let me put that into the right part of the chat. My email is super easy. It's ben@fundify.com. And I am the only Ben Kromnick in the world. I stand by that. And you can prove, I hope you can prove me wrong. So I'm easy to find on LinkedIn as well.
Cool. Okay. Well, great. Well, appreciate that. And if anybody who needs to connect with Ben, you can connect there. If you have any questions, we'll be glad to connect people afterwards as well. But appreciate everybody joining us today. Great stuff. And looking forward to seeing you guys back next time. Ben, thanks so much and have a good one.
Thanks all. Great to see you. Thank you, everybody. Thanks for the great questions.
Thanks. Bye-bye.